A sudden decline in Indian defense stock following the Tejas airshow mishap is a textbook example of how modern financial markets react not to fundamentals but to perception, symbolism, and narrative shock. When news broke that a Tejas aircraft has crashed during a demonstration flight in an international airshow, the market response was swift and emotional. Shares of major defense-linked companies such as HAL, BEML, MIDHANI, and several ancillary suppliers fell sharply within hours. This reaction was not driven by balance sheet deteriorating, order cancellation, or policy reversals, but by far a more fragile force, investor psychology, and operating under uncertainty and headline pressure. At the core of this episode lies the difference between operational reality and market interpretation. From an engineering and defense procurement standpoint, an airshow crash, especially one occurring during high-risk maneuver rather than a combat or operation site, is not unprecedented, nor is it automatically indicative of systematic failure. Modern aircrafts, modern fighter aircrafts operate at edge of aerodynamic envelopes, particularly during display flights designed to impress foreign buyers and domestic audiences. Such environments amplify pilot input sensitivity, making errors more visible and consequences more dramatic. However, markets do not price nuances in real time. They fear price, especially when they fear when that fear can be easily packaged into a single emotional charged headline. Defense stocks are uniquely vulnerable to this phenomenon because they sit at the intersection of national pride, geopolitical signaling, and long cycle capital investment. Unlike consumer good or IT services, defense manufacturing is not judged quarter by quarter on sales growth alone. It is judged on reliability, trust, credibility, intangible that takes years to build and minutes to question. When an aircraft crashes on foreign soil in front of international delegates, the immediate assumption among short-term traders is not what caused this, but how will this look. This distinction matters because markets often trade optics below facts. The sell-off was amplified by positioning. Indian defense stocks had already enjoyed a strong rally in the months preceding the incident, driven by narratives around indigenization, import substitution, rising defense budgets, and India's aspiration to become a global arms exporter. Valuations had expanded, expectations had risen, and many participants were sitting on a meaningful unrealized gains. In such conditions, even marginal negative trigger is enough to initiate profit booking. The Tejas mishap provided precisely that trigger. Once initial selling began, the algorithmic trading systems and momentum-based strategies accelerated the decline, creating the appearance of a sector-wide problem where none structurally existed. It is important to separate the company-specific implications from a sectoral overreaction. For HAL, the manufacturer of Tejas, the immediate question concerned order continuity, production schedules, and possibility of grounding. On all three counts, the long-term picture remained intact. The aircraft was not operating in mission mode. There was no indication of a design flaw at the time of the incident, and domestic orders driven by the Indian Air Force chronic squad shortage were unaffected. India's requirement for combat aircraft remains acute with squadron strength well below sanction levels and no realistic alternative supplier capable of replacing HAL in the near or medium term. From a strategic procurement perspective, a single mishap doesn't alter that reality. However, exports operate under a different logic. Foreign buyers are more sensitive to perception risk, particularly when evaluating platforms from emerging defense exporters, even if technical cause is benign. The optics of repeated incidents within a short frame can slow negotiations, extend evaluation period, or encourage buyers to seek additional assurances. This doesn't necessarily translate into cancellations. Thus, when domestic demand provides a solid floor for revenue visibility, export narratives inject volatility into the stock price. Broader defense ecosystem felt the impact because investors rarely discriminate with precision during moments of uncertainty. MIDHANI, which supplies critical alloys and materials, BEML, which produces armored vehicles and heavy platforms, and other defense-linked firms were sold not because of direct exposure to the incident, but they're mentally grouped within the same thematic basket. This is a common feature of sectoral corrections. Correlation spikes precisely when differentiation matters most. In, ca- in calmer conditions, investors speak of subsector strength and company specific fundamentals. In volatile conditions, everything moves together. From a macro perspective, the incidents highlight a deeper truth about markets in the age of instant information. Financial systems today are not merely mechanisms of capital allocation, they are narrative processing engines. They absorb news, assign meanings, replace assets based on how the news fits into existing stories. In this case, the prevailing story was one of flawless indigenization, progress, and uninterrupted ascent. The crash introduced dissonance into that story, forcing a rapid revaluation not of cash flows but of confidence. That revaluation manifested as a price correction. Yet history suggests that correlations are often temporary and are not supported by structural change. India's defense modernization drive is anchored in long-term policy, not single events. Budget allocation, force planning documents, and procurement pipelines extend over decades. Manufacturing ecosystem once built are not dismantled because of one setback. If anything, incidents often lead to incremental improvements in training, procedures, and systems, strengthening the platform over time. Markets, however, rarely wait to see that process unfolding before reacting. In a final analysis, the fall in defense stock after the Tejas crash was less a verdict on Indian defense capabilities and more a reflection of market mechanics under stress. It was a collision between long-term strategic reality and short-term financial reflexes. For traders, such moments are opportunities to reduce exposure or exploit volatility. For long-term investors, they are tests of conviction, moments that reveal whether one is investing in a narrative or a structural transformation. The difference between two determines whether a crash in the sky becomes merely turbulence on the chart or a lasting scar on investment thesis.